All right, let's talk about one of the oldest debates in investing, dividend stocks versus growth stocks. You've probably heard the simple version. Dividends are for steady income, growth is for getting rich. But what if that whole story is, well, wrong? We're going to dive in and find out what really matters when you're building your strategy.
Yeah, this is the story everyone tells, right? Over here, you've got your dividend stocks, the safe income play. And over there, the flashy growth stocks, your ticket to risky riches. It's a nice, clean story. But you know, when things in finance sound that simple, there's usually a catch.
So, is it really that black and white? Not even close. And the reason why might actually surprise you. It all comes down to one sneaky little detail that most investors just completely miss.
Okay, so first up, let's tackle the dividend stock. What are you actually getting your hands on when you buy into one of these companies?
It's pretty straightforward, really. A dividend stock is a piece of a company that decides to share its profits directly with you. They literally send you a piece of the pie, a cash payment that usually lands in your account every 3 months.
I love this way of thinking about it. Imagine you have a friend who just sends you $20 every month just for being their friend. You don't have to do anything. It's just their way of saying, hey, thanks for sticking with me. That's kind of what a dividend is.
And where do you find these kinds of stocks? Well, they tend to hang out in certain neighborhoods. You've got real estate investment trusts, which are kind of like being a landlord without the late-night phone calls, or consumer staples, think Coca-Cola, companies that sell stuff we all buy, no matter what the economy's doing. And of course, the big banks and energy giants are classic dividend machines.
So you might be scrolling online and you see a number like this, an 8% dividend yield. And your brain immediately goes, whoa, an 8% return, guaranteed? It looks like a total no-brainer, an amazing way to crush inflation.
But hold on a second. Is it really a guaranteed win? This right here is a classic trap that a lot of people fall into. A super high yield can often be a huge red flag waving in your face.
And this brings us to the golden rule of dividend investing. You have to invest in a solid business first. The dividend, that's just the cherry on top. See, a crazy high yield usually means the stock's price has tanked because investors are worried the business is headed for trouble. And that 8% yield isn't going to feel so good if your stock itself drops by 20%.
All right, let's flip the coin. Let's talk about the other contender in this fight, the ambitious growth stock. This is a whole different ballgame. This is all about betting on what's next.
A growth stock plays by completely different rules. Instead of sharing its profits with you, it takes every single dollar and plows it right back into the business. The goal? Grow as fast as humanly possible.
So if the dividend stock is your reliable friend, the growth stock is that ambitious, slightly crazy friend who says, look, don't worry about getting paid now, just trust me, I've got this incredible plan. You're betting their grand vision is going to pay off big time.
So what's the game plan? It's simple. No dividend checks for you. All that cash is used to build new products, expand into new countries, and just conquer the world. The bet you're making is that all this aggressive growth will make the company so valuable that the stock price just skyrockets. I mean, look at companies like Tesla, Amazon, and Nvidia. This is the exact playbook they used to become the giants they are today.
Okay, so we've got the basics down. But now we get to the part that changes everything, the part almost no one considers. Let's talk about the sneaky tax trap.
And boom, here it is. When you get a dividend, you have to pay taxes on it that year, every single year, even if you just turn around and reinvest that money. But with a growth stock, you pay zero tax until the day you decide to sell. This difference creates something called tax drag, and trust me, it's like trying to run a race with a parachute strapped to your back.
Just look at what this does over 20 years. That bar on the left, that's a dividend portfolio getting a little haircut from taxes every single year. And the one on the right, that's the growth stock, just compounding away, untouched. That huge gap between them, that's the magic of uninterrupted compounding. It's real money that could have been working for you.
So you're probably thinking, great, so dividends are just a tax nightmare? Well, not necessarily. What if you could get the best of both worlds? There's actually a kind of investor cheat code for this exact problem.
It's called an accumulation ETF, and it's pretty brilliant. Here's how it works. The fund itself collects all the dividends from the stocks it owns. But, and this is the genius part, instead of handing them to you and triggering a tax bill, it just automatically reinvests them for you inside the fund before taxes ever touch them. Your money gets to compound at full speed.
But wait a minute. Before we all run out and ditch dividend stocks forever, let's pull back. Because despite that tax issue, dividends are a huge, huge part of the long-term story. Just look at this. Since 1940,
Over a third of the S&P 500's total return has come from dividends. That's massive. It just shows you how powerful that steady drip of cash really is.
Then again, you just can't argue with the raw power of growth, especially in the last decade or so. Between 2010 and 2020, the market went on an absolute tear, soaring over 400%, and that was almost entirely driven by the price of growth-focused companies going to the moon.
So, after all that, who wins? Is it the dividend stock or the growth stock? The truth is, it's neither. There's no single winner here. The best strategy is the one that's best for you. It all comes down to your personal goals, how long you plan to invest, and frankly, what helps you sleep at night. So now you know the real deal. You know the differences, the hidden tax traps, and the smart ways to get around them. You have the playbook. The only question